Hi, I'm Roger Aguinaldo, and welcome to the M&A Advisor podcast. Since 1998, the M&A Advisor has been the definitive source dedicated to recognizing achievement, delivering unrivaled thought leadership, and connecting the world's mergers and acquisitions elite. We help you sharpen your edge and accelerate your success in deal making. Whether you're an ambitious new player or a market veteran, this podcast provides masterclass strategies, unvarnished stories, and vital lessons from the industry's influential figures. Before we launch into this episode, be sure to follow us on YouTube, Apple Podcasts, and Spotify, and subscribe to our essential M&A Alerts email newsletter. Find all the links below. Your engagement fuels the deal-making community. Now let's get into the transaction.
Good afternoon, Marc McCabe. Nice to see everyone. I am with Alliant Insurance Services out of New York. Alliant Insurance we're actually the largest privately held brokerage firm in the world, focused mostly middle market. We're a specialty brokerage operation that has 16 specialty verticals. I work within our M&A vertical. So effectively what we do is we work with about 300 buyout firms or so around the U.S. We work on pre-close due diligence. We've worked on well over 10,000 transactions over the years. We also represent and do insurance work for over 1,000 portfolio companies owned by buyout firms around the U.S. And what's really cool about our M&A practice is that we're a privately held brokerage firm. We have about 12,000 employees, $5 billion top line revenue. We put about $50 billion into the marketplace, which gives us tremendous amount of leverage when negotiating with insurance companies. And I think what's also cool is that as a privately held firm, about 20% of the operation is owned, the equity is owned by VP or higher. So there's a lot of stickiness to the firm and a lot of consistency in our deliverables.
Good afternoon. I'm Erika Highland with Gladstone Investment Corp. Gladstone Investment is one of 4 funds that's managed under the Gladstone umbrella. All 4 funds are publicly traded and have an orientation to providing consistent monthly distributions to our shareholders. So as an investor, we look to invest both debt and equity in all of our portfolio companies, and we effectively think of ourselves as a buyout fund operating within this publicly traded vehicle. So, we look to acquire businesses between 4 and 15 million of EBITDA, transaction values roughly 25 to 100 million, and we would effectively provide all of the capital, both debt and equity, to fund those transactions alongside partners such as independent sponsors or management teams. As of today, our portfolio is just over $1 billion of assets, about 29 portfolio companies across a variety of verticals, including manufacturing and industrial businesses, consumer products and services, and business services. And all of those companies are primarily based in the U.S.
Good afternoon. Appreciate everyone sticking around on a Tuesday afternoon to talk about diligence with us. I know it's not the most exciting topic, but my name's Jeff Michelson. I'm a partner at Cohn-Resnick's Transaction Advisory Services practice. We do buy-side and sell-side diligence, helping folks like Erika when they're looking to make a deal. We do financial and tax diligence. That's what I do during the week. On the weekends, I support my family's deli in New Jersey. We invested in a franchise deli like Katz's, so if you're around in Jersey, come on by. We'll make you a sandwich. I'm also a science fiction author. I think you knew that, Marc, right? I wrote a book that came out last year. So looking forward to the conversation. Appreciate everyone joining.
Terrific. And I'm Dan Lee with Pin High Strategies. I've spent 30 years in the private equity and lending markets. Currently, we're providing merchant banking and consulting services to independent sponsors and smaller private equity funds. So let's start talking about the state of the market. So I guess as context, we're past year 3 of pretty paltry M&A activity, coming off of a red hot 2021. It felt like we were ready for a pause and got it in 22 with the war and inflation and the interest rate increases, and then we got SVB, and then an election. So, we've been waiting for years for the market to pick up, and that's created a very competitive M&A market with a lot of dry powder looking to go to work. So, from a diligence standpoint, how have you seen firms react to that? How have you seen them adapt to that challenge?
I'm thinking maybe Erika. So I'm fortunate to do quite a bit of diligence work, and Jeff as well. With regard to the Gladstone Investment Company. But I'm thinking it might be worthwhile if you could just give a little color, kind of on deal activity, what you're seeing.
Sure. Yes, overall deal flow has been lower than it was back in that 2021 timeframe. But particularly in the lower middle market, there are still really consistent opportunities that come out. There's always going to be, families that need to transition from an entrepreneurial standpoint to an institutional capital, or where the next generation of leadership doesn't want to be involved, or private equity funds that need to exit their investments in order to return capital to their shareholders and raise new capital. So, from our perspective, while the total deal flow has been down, the quality of deal flow has actually been pretty decent. And then you couple that with the amount of dry powder that you mentioned, Dan, that is out there that makes getting a deal done in today's market increasingly competitive. So, I'd say overall valuations are slightly more modest, but the competition for those assets has just increased significantly. One of the things that I think has led to us having a more active, at least last 12 months. We've actually had our busiest 12 months in the history of our fund, over 20 years last year. Closing 5 new platform investments has been our ability to provide, all of the capital for a transaction, increasing that certainty to close. But it's not just the availability of capital; it's also having really reliable partners throughout the investment process, including on the financial due diligence side and on the insurance side, that lead to that certainty with the compressed timelines, the ability to commit to and follow through on your commitments from a timing standpoint is really a requirement from a relationship standpoint with your deal sources.
Yeah. Go ahead, Jeff. Want me to jump? So I was just going to say, what's interesting, for example, with Gladstone, we'll get a call with regard to diligence, typically at LOI, right? So our first question to the buyout fund, to the deal person is, what is the timeline? Because we want to make sure that we're going to diligence all the insurances and, get in front of the curve so that the deal team can make, informed decisions about the company they're looking to acquire. So typically, though it takes us some time to get through the diligence phase, our goal is first and foremost is to bring clarity and to bring confidence back to the deal team about the deal that they're looking at. So we will quickly get into the legal liabilities, look at the history of the company, look at the claims history, claims trends, look at the insurance structure, look at the cost structure, and then come back to to Erika, the deal team, her colleagues, whoever it may be, to say this is preliminarily what we're considering, what we're looking at, and then we'll do a deeper dive. But at least that gives the deal team some confidence early on that, at least from an insurance perspective, this thing is not going to blow up. And then I think that would probably transition over to accounting and quality of earnings.
Oh, absolutely. There's a lot of things that blow up on an accounting perspective. Yeah, I mean, look, similar to Erika, our clients are definitely busier. We were busier on the sell side, 2 or 3 months ago, which naturally transitions to a lot more companies being out in market, which is great. I think our clients have gotten a little bit more creative over the past few years with where they've sourced deals. But obviously as part of that, when you're getting more creative with your sourcing, the quality might come down a little bit. It's good to hear that your quality is going up. But when it comes to, financial diligence, it may be boring in some people's minds, but it's the foundation for the deal. Our clients aren't turning on legal, aren't turning on tax, aren't turning on insurance until they get a sense that the financials are solid, right? I mean, think about selling your house or buying a house, if the foundation of that house is not solid, it's going to be a deal killer, or at least a deal changer. So in any deal, the financials of the business are the foundation for the deal. So I would say, 2 or 3 years ago, when things were busy, buyers were saying, oh, 50% of EBITDA being added back, okay, fine, we just got to get a deal done. Now there's definitely more scrutiny on the add backs, on the financials and how it ties to the forecast. You want to make sure you're getting a good company when you buy it. So it's definitely a lot more scrutiny. They want more certainty, our clients do, and things are still blowing up a little bit, but not as much as they were.
And I would add too that as even in the lower middle market, you mentioned the sell side diligence, almost all businesses, even smaller ones, are coming to market pretty well prepared, having done their sell side quality of earnings and having reviewed other potentially key risk areas of a deal. So by the time a buyer gets a deal under LOI, the buy-side diligence, I won't quite say is perfunctory, but it's become increasingly streamlined because of all that preparation. And at the same time, though, having trusted advisors to do that work at the level of depth that's required, but again, both on the financial side and on insurance, legal, environmental, all the other areas, those are really, really critical risk management aspects of a process so that, again, we know you're buying a good company, you know you're getting it for the value that's fair and reasonable and what you committed to, while also having that credibility with the advisors or other transaction partners that you're bringing issues to the forefront that are legitimate issues and not just ones that are trying to change your negotiating position somehow.
So I think that's an important point. You're seeing sellers are putting together the diligence themselves, the QofEs, the market studies, and buyers are being pushed to do their work much faster. The timelines are compressed. The processes are tightened. What challenges and red flags do you see people encountering in that environment, and how are they addressing it?
I guess from a challenges standpoint, it's simply the clock. Oftentimes, again, we have limited team, our advisors have limited teams, and you get the call and you're on the clock to close in whatever timeline you're committed to, whether that's 30 days or 45 days. Very rarely do you get a 60-day window in today's market. So you really have to be very well organized. I think it's really important to have strong relationships with all of your advisors. Again, to get ahead of potential areas of issues with the deal, even perhaps before you formally engage, so that when you sign that LOI, you're ready to sign the engagement letter and move forward into diligence, because you're running multiple streams at once with diligence, with all the legal documentation. And at this point in the process, the management teams are often quite fatigued. So your advisors are an extension to you as a buyer, and their experience of working through them is kind of a preview of what a relationship will going to be like. So that's really, again, critical area, especially as timelines get more compressed.
Yeah, and it's a great question, Dan. When I think about the the diligence phase of what's happening around the pre-close due diligence, we're spending a lot of time looking at the target company coverage terms, conditions. We're looking at their, as I mentioned earlier, their claims history. We're looking at compliance. We're looking at all their customer contracts, making sure the insurance policies are in alignment with the contracts. Because if they're not, right, then we have to go back to the deal team and say, we're missing coverage here, we're short here, et cetera, and all that, equals, more dollars potentially, for insurance costs post-close. We're also looking for, problem areas. Our goal is to make sure the deal teams don't have any surprises, after they've closed on the transaction. Like Jeff says, you run out, you buy a house, you're so excited about the home, and then after you've closed, you've signed the contracts, you find something, terribly wrong with the home. You never want that to happen. So, in our world, if I can just maybe cite a couple of examples, a year ago, one of our portfolio companies was looking to do an add-on. It was a manufacturing operation, and they were buying a piece of a large conglomerate. And with that piece came a large building down in the Houston, Texas area, which was in the flood zone, wind zone area. from a safety perspective, housekeeping perspective, it wasn't exactly a high IPA, wasn't very insurable by the insurance company. So we needed to bring that back to the deal team and say, listen, just so you know, acquiring this location in Houston is going to have a big impact on the property, the cost of property insurance. So the deal team was able to take that information, take that knowledge, and I assume probably go back to the sellers and renegotiate some of the terms, knowing what they're about to take on. Real recently, we have a situation where one of our contracting clients is making an add-on acquisition. In going through the general liability coverage and looking at all the exposures, it's a $12 million revenue company, and the insurance policies are showing it's a $300,000 revenue company. So when you take that delta, of 11,700,000 times whatever the rates are, it's real premium. And then the deal team's got to factor that into the cost of the transaction. So at the end of the day, we just want to make sure we can eliminate the surprises and help the deal teams understand what the pricing is going to look like, pre-close versus post-close.
Yeah, it's a good question. I think, to Erika's point, everyone's being asked to do deals lightning quick now. I think from our perspective, setting the proper expectations in terms of what we still need to do our work is important up front. You mentioned the sell side. We had a recent, actually we're doing it right now, where there was a sell side and they were asking us to, they gave us the sell side report on a Friday, they wanted to have a call on a Monday, and they wanted us done with our diligence on the next Friday. Like 1 week to do our diligence. And it's like, come on, guys, we need a little bit of time to digest and understand. What ended up happening is, for a $6 million EBITDA business, we found $1.5 million revenue adjustment that is changing the deal. And so just setting those expectations up front that, yes, we know there's preparation being done, but we still need time to do our analysis and dig in and understand the business. It's very important up front, whether it's financial, whether it's tax, or it's legal and insurance, that just because there's prep work being done doesn't mean you can close a deal in 15 days. That expectation has to be there, that there's diligence that's going to be performed, it's going to take time, and there's proper diligence, hopefully, that's being done so our clients can share with their third parties.
Terrific. Good. Let's go ahead and take a look ahead. I think we're going to see a pickup in deal flow at some point here, right? I think. And bankers are saying that that's on its way, that we're starting to see a pickup, and we're certainly seeing pickup in IPO activity. It's still historically low, but it is starting to pick up. So hopefully that's a sign that some animal spirits are returning. And so I guess I'd like to ask, number one, what's your outlook for M&A activity for the rest of the year in 2026, and how will that impact diligence on those deals rolling forward?
Can I just ask a quick question, though? Has Donald Trump tweeted anything today that might impact that I'm not aware of?
Assume yes.
Well, I know isn't Eric doing an IPO today on blockchain or Bitcoin?
Yes. And I also saw he announced that public companies only need to report every 6 months now instead of quarterly, so that might change a few things. Yeah, I'll just go quickly first. I mean, we're already seeing a pickup. I think what happened is we're seeing a lot of refinancing, recaps now that are coming to market from COVID, basically. So that's keeping us busy, but we're also seeing a ton of buyers. I mean, again, buyers are finding deals. And as a firm, we're helping buyers find deals. We know, if there are any brokers in the room that want to send us a deal to share with our clients, please do. But we're trying to be better deal connectors, but our clients are finding more creative ways to get deals done, and as a result, they're busier. So I think the rest of the year, absent any tweets or truth socials or whatever, that might change things. Obviously, we still have tariffs, obviously, interest rate uncertainty, but our clients want to do deals, and I think sellers are starting to realize they want to do deals. We had a lot of sellers a year ago that said, not the right time, tariffs, election uncertainty, whatever. They saw their friends sell for 12 times EBITDA 2 years ago. I think they're starting to come back, and I think as part of that, our clients are waiting and ready to do deals. So I think, it's going to be a good year for all of us, busy year. I hope so.
Yeah, I would agree with all that. I mean, we're hearing from a lot of the advisors and investment bankers that we see opportunities from, that there's increased pitch activity, a lot of preparation work that's being done now in anticipation of bringing those opportunities to market either later this year or in 2026. Some of that, again, is because of the kind of pent-up activity over the last couple years. As the environment settles, those sellers can only wait for so long. I also think in the private equity fundraising community, again, those funds need to exit their current portfolio to return capital in order to be able to raise the next pool of capital. So just to be able to maintain the amount of capital out there for additional opportunities, those exits will need to come to market. And I would say too, just from from what we're seeing in the market, I think even in this Q3, Q4 of 2025, there's been continued strong activity, and we've got a number of opportunities we're currently working through that could potentially close in the next 6 to 12 months for sure.
No, it's interesting, and if we're a barometer of the activity and deal flow in 2025, given a lot of speculation about the amount of activity that we're seeing out there, our firm has been busier than ever. We had a high benchmark going into 2025, and we're well exceeded our goals and expectations. We're seeing a lot of add-on activity with our platform deals. Particularly those types of deals are coming across our desk. We're getting involved in the diligence, and those add-ons seem to be have a lower barrier to entry in terms of getting them closed. So we're seeing a lot of that, which is keeping us busy. And of course, I don't want to get into the weeds on rep and warranty, but that's become a big part of these transactions nowadays, and in lieu of escrow.
Great, and so I want to shift gears a little bit and talk about one of the emerging trends in private equity that's gone relatively underreported, which is the emergence of the independent sponsor asset class. So just as context, pre-GFC, there were very few. They were called fundless sponsors, frankly, and there were very few of them. They started growing, but if you go back to 12 years ago at an independent sponsor conference, there were about 50 independent sponsors, some of whom owned one portfolio company, and generally played below the private equity radar, so small businesses, low single digits EBITDA. Today, there are thousands of independent sponsors, and many of those are private equity firms. They own businesses that have multiple portfolio companies. They own businesses that have 10, 20, 30 million of EBITDA. So they've become, and bankers are now allowing them to participate in processes. So they've become an increasing part of the private equity landscape. And with the challenge of private equity fundraising, it looks like we're about to see another leg up in growth in this asset class. So the challenge, of course, is that they don't have capital, and if the deal breaks, that's your exposure as a diligence provider. So I'd like each of you to talk about if you work with independent sponsors and how you address that challenge.
I guess I'll start because working with independent sponsors has been a core piece of our strategy almost since the beginning of our fund back in 2005. So if there's independent sponsors looking for capital, we're happy to be your capital provider. But as the market for independent sponsors has grown, I'd say it hasn't emerged. It's become more formalized, I'd say. And whereas in the past, you're right, we saw a lot of small companies, perhaps a roll-up strategy of $1 or $2 million EBITDA businesses that an individual would look to raise capital to put together. But now you have executives coming out of private equity funds doing deals on a one-off basis. You have individuals with really, really deep industry and operating experience effectively looking to buy a business and run it and looking for capital to provide that. So there's really been an emergence of all different types of independent sponsors who are all, again, they have a deal but are looking for capital. For a group like ours that is, relatively small from a management standpoint, but managing a relatively large portfolio in terms of number of deals that we have, independent sponsors are an invaluable component of what we're looking to do, not only because they're bringing us opportunities that are perhaps not widely marketed and where we have a competitive edge to even being able to get the deal done, but also in their operating experience and relative to this discussion through the diligence process. Many of them are very experienced deal professionals. They know how to run a process, and they are able to do a lot of the legwork with respect to diligence, to the point of even bringing us basically a fully packaged deal with the QofE and all the other work done that we basically need to review and sign off on. And so again, it's become highly value added, and especially for those groups where we've gone back to 2-3 times, there's a deep trust factor there. So it's again a growing and an important segment of the business.
Just before I answer this question, are there any independent sponsors in the room? No? Okay, all right. So I guess what I'll say is it's a challenge to work with them for a few reasons. One, there's no fund. So, from a fee perspective, there is no guarantee of collection if a deal dies. Secondly, I talk about the foundation of a deal being the financials. A lot of the businesses are looking at, there is no foundation. It's like one of those small houses they sell on Amazon that's just kind of there. It's a challenge. I mean, some of these companies are not even on QuickBooks. They might be on, I've seen a few on Quicken, which is not easy to work with. So when we think about our work, yes, it's a challenge. If the deal dies, there's no guarantee of collection. The companies are looking at, there may be some EBITDA, but again, from a financial perspective, maybe there's an accounting manager. The vast majority of the time, they're utilizing their outside accountant on a tax basis. There is no GAAP accounting, no accrual accounting, none of that. And they want you to do a deal for $10,000. So it can be a challenge, but the view from our firm's perspective, and we're very involved with iGlobal, there's a McGuire Woods conference down in Texas. So we've been working with independent sponsors for a while. The goal is a long-term relationship, with the view that, you do one deal, you hopefully close it, leads to more deals, more audit and tax opportunities. So you can kind of build that relationship from the ground up. But as a quality of earnings provider, I'm usually the first one that they come to for work. There is risk, and you kind of have to factor in. But they are looking at real businesses, and certainly our work with independent sponsors has picked up significantly, and it's not going anywhere. So we have to be creative with how we work with them. But like I said, it's definitely a challenge, but so far it's worked out.
Yeah, no, 100%. And I think the independent sponsor model is going to expand, not contract over the coming years. And I say that, number one, because firsthand I've had the opportunity to work with some independent sponsors who had been, with large private equity funds, and then spun out and started their own practice separately, and they've been very successful, raising capital and getting deals done. What I'm seeing is some of the middle market private equity funds are having a lot of challenge raising additional, money for new funds. And I think that's going to continue because you have some of the mega funds like the Blackstones and the KKRs and the Warburgs, et cetera, that are coming downstream to play, more of that middle market, lower middle market, which I think is creating much more opportunity for the independent sponsors.
The one thing I'll just quickly add is, the independent sponsors really rely, you mentioned trusted advisor. We are really their trusted advisor. I mean, financial, tax, HR, cyber, IT, all those areas that they need. And a lot of it depends if they do need reps and warranty insurance, right? Because a lot of those providers will require a significant amount of work around taxes, around IT and cyber. So there's really a huge opportunity to provide a bunch of services that maybe our private equity friends don't necessarily need.
Yeah, it's interesting. The other element, tailwind that I didn't mention that's interesting is that the frozen fundraising environment is going to help some committed funds find religion on the independent model, and that they're going to realize that they can move to an independent model, and SPV investing has its advantages, right? In that it's standalone, and so I think you're going to see some firms, frankly, move to this model, and it's, please.
Yeah, they're already doing it.
Right.
We're seeing some, names that you would recognize, really experienced private equity funds that have a long, long track record that have simply decided, it's too complicated to raise a fund, but they've got a really strong investment mindset, so they're able to go out and basically build a portfolio on a deal-by-deal basis with different financing sources for each of those deals. And they've found it easier to just manage the portfolio and create value without having to report back to a set of LPs.
Yeah, absolutely. So and we've seen there's groups like North Castle Partners that's done it very successfully. They moved from the funded to the independent model. I guess we've got a few minutes left. I want to see if there are any questions. Okay. So I think we obviously covered it well. I guess to close, if you could just give us your perspective on the biggest, if you see any changes to the direction of diligence continuing to get more competitive, do you see the environment normalizing at some point and going back to something that looks like 2019, or are we in the new normal?
I'll kick off real quick. I think the one thing we haven't touched about is AI, and everyone's talking about AI and the impact of all that. We're already starting to see that. To the point of speed earlier, I think at some point the expectation is you're going to be able to turn around a quality of earnings report in not 2 weeks, but essentially 1 week. There's already technologies out there that are allowing for the processing of a data room in the matter of hours. And it's scary and it's coming, but I think that's going to be the expectation, especially from private equity, that you have access to a data room, you have a data book in a day, you have management meetings in a day, and you're able to turn around a report a week later, or whatever the case might be. Now, I'm not saying that's going to happen right now, but we are starting to see certainly firms come onto market that are offering that. And I think internally within Cohn-Resnick, and I know other accounting firms are spending a ton of money in investment on AI, and so we'll see where that leads to in terms of how the diligence process plays out. And I'm not suggesting that AI is going to be talking with AI to negotiate deals, but I think you will have the process being handled more by AI than certainly are now. I'm already getting emails from AI or artificial EAs that are just scheduling calls and meetings and all that. It's pretty scary, pretty funny. But I think that's what we're going to see in the next year or so, and kind of how that looks, I don't know, but it's coming for sure.
Yeah, I don't see a world where timelines aren't going to continue to be compressed and competitive. Again, not only because of the technology tools that are out there, but once you get a universe of sellers expecting that kind of a time frame, it's awfully hard to go back to a 60 to 90 day due diligence period. That's just not going to happen anymore. So I think we need to be comfortable with the increased and compressed timelines, but that doesn't change the quality of the diligence at all. The concerns are still out there that are we getting a fair deal, and are there any hidden issues or red flags we need to be aware of? You just have to do it faster. I was also going to mention just the types of due diligence, and maybe Mark, you can talk to, for example, on cyber due diligence and IT due diligence. Those used to be, kind of one-off diligence tasks on certain deals where there's a particular risk factor there, but it's increasingly become something that we look at on every deal, and I imagine you're seeing others that are focused on those areas too.
Yeah, just before we go there, Mark, Erika, you could touch on how Gladstone is using AI. Are you using it in sourcing, underwriting at the portfolio company level?
Yeah, well, at the portfolio company level, there's a really wide variety. Actually, last week we had a portfolio-wide conference with all of our executives, and probably we had 3 different speakers on AI and how the portfolio companies can use it from everything from kind of basic day-to-day automation to strategy development and building out a strategic plan for your business. So we're hoping to see more evolution there. Within our fund itself, we're using it more on the front end of a deal process to, try to screen opportunities, determine those are really the best fit for our investment parameters. generate questions that we can use to ask of industry experts and other advisors to help us get a read on things. But we really haven't, once we have a deal under LOI, we're still making sure we're sanity checking everything and doing everything ourselves. It's a good way to get started, but we're not using it as a sole solution.
Yeah, no, that's great. And, with regard to, your question, and Erika, with regard to the, cyber and cybersecurity, so what's happening is as we kind of look forward and understand how Diligence is going to look going forward, there's so much scrutiny now that we're putting into cyber insurance, cybersecurity, social engineering, malware, ransomware. There's so many components. So we've brought in, an army of, cybersecurity experts who can help us understand, what the networks look like, what the multi-factor authentication, et cetera, looks like, so that we can go back to the insurance companies and negotiate cyber coverage terms, conditions that are broader, can address, cyber losses because they can be, catastrophic. So that's there's also a lot of data-driven analytics that are going into our due diligence going forward. You're going to see a lot more data analytics, much more sophisticated. The diligence reports, I think they used to be kind of like check the box, make sure everything's cool. Now they're becoming much more strategic documents so that, the deal team and, Gladstone, Erika's team, they can use these documents going forward to work with the boards and work with the operating companies to, better understand how to structure, insurances and address risk management issues, make safety better. And I think lastly, what we're doing now is we're doing a lot of portfolio type insurance work whereby we'll look at, 25 or 30 portfolio companies and we'll put a cyber insurance program in place for all the portfolio companies to get better coverages, better limits, better cost structure that has a big impact on EBITDA. And we're seeing a lot more of that trend.
Yeah, and I'll just quickly add to that. We're starting to see more RIFs in companies that we're looking at. Over the past year, with all the uncertainty going on, a lot of those RIFs were just operationally, they were just trying to improve margins. Now we are starting to see RIFs because of AI. And I think for the investors that we're working with, it's, like, how real is this? How real are these savings around payroll offset by your AI costs going up? So it's something I think over the next 12 months we'll see more of, unfortunately. We've already started seeing that in the news, and I think you will start seeing more of that. But it is becoming more frequent in the companies that we're looking at in the middle market where you do have RIFs because of AI.
Interesting. So unless there are any parting thoughts, I think that's what we're looking to cover. We appreciate everyone's time, and I think we'll get back to rooting for an uptick in M&A activity.
And listen, Notre Dame, 0-2, but you're still in the top 20. I think you're the first team in the history of college football.
Why would you ruin the panel?
Yeah. No, there's still hope. I want you to be optimistic.
Yeah, I appreciate it. Thank you. I'm always optimistic. Thank you, everybody.
Thank you.
We hope today's episode delivered actionable intelligence. We want to hear from the field. Share your questions or insights, leave a message on your favorite platform, or email us at editor@maadvisor.com. To secure your steady feed of premium M&A content, follow us on Spotify, Apple Podcasts, and YouTube, and subscribe to our M&A Alerts email newsletter. Find the links in the description below or visit us directly at our website at www.maadvisor.com. I'm Roger Aguinaldo, founder and CEO of the M&A Advisor. Thank you for being part of the M&A Advisor community. Until next time, stay decisive, stay connected, and happy dealing.